Well, we're heading into trouble. Federal Reserve raised interest rates 0.75% today, July 27th, 2022. And they raised interest rates into a declining economy and an economy that is rapidly declining. And of course, it isn't just happening here in the United States. Across the globe, it's happening. It's a global phenomenon. I mean, Europe's just in terrible, terrible shape. And they raised interest rates. This is foreboding some real problems. Now, Charles Nenner and I talked about this 2 weeks ago, and as it per forecast, it is just unfolding right before our very eyes. Let me go to my very next slide. Let's just talk about this. I don't want to make this a really, really long video. We just need to talk about some really quick things. Now, in our video last week, it's only been 2 weeks ago, he talked about high inflation, rising interest rates, slowing economy, and lots of other things. But now this is my asset class. You know, I'm going to talk a little bit about real estate here. But Charles talked about high inflation. Let's just go to my very first slide. Look at this. And this is all over the news. You know, in May of 2022, we printed an 8.6% inflation rate. It's 9.1% for June. Now here in Phoenix, we just had some headlines saying it was 12.1% in Phoenix, Arizona. I can't confirm that, but we've had some headline numbers that high. Now I think we're going to get some moderation. If you go back to our video, there'll probably be a little bit of moderation because we've got demand destruction going on all across the globe. So we're seeing the producer price index starting to slow a little bit. For Charles, it's going to be a pervasive problem. We're going to be stuck with inflation for a really, really long time. I'm not sure why. Could be shortages, because there's a lot of us. You know, if there's not enough, I know here in Arizona, we're looking for glass. Can't get hold of glass. Can't get that anywhere. Having trouble getting all kinds of things. It was appliances. Now it's glass. Let me go to my next slide. Let's just talk about that. Here's the other thing we talked about was rising interest rates. And sure enough, you know, Federal Reserve raised today. Well, we've been seeing this in mortgages. So look here, December 23rd, I just picked this number. In December of last year, it was 3.05 per the Federal Reserve electronic data system. I mean, this is authoritative. This is Federal Reserve. This is the average rate of fixed rate mortgages across the United States. And now they're 5.5%. They're up enormously. This is driving people's home prices up, their mortgage prices up. I mean, if you're building, this is probably one of the problems. We're going to talk about that, but this is one of the problems is that people bought a house thinking that they were going to get delivered in 4 or 5 months and then find out it's going to be a year and a half. Now they're getting their homes delivered. They thought they're going to have a house payment of $2,000. Now it's coming in $3,000 and they can't afford that. And it's just causing problems. So how would you like to have bought a house a year ago thinking that you're going to have a $2,000, $2,100 a month house payment, and now it's going to be $2,800 to $3,200? That's a lot of money increase, and this is a problem across the country. It's not just confined here to Phoenix, Arizona. Phoenix, Arizona is going to do much better than most places around the United States. Same with Texas, Florida, and Phoenix. Let me go to my next slide, and let's just talk about that one. So this is going to cause turmoil across the world. Now, we're talking about raising interest rates into a negative GDP. So we just got this print from the Federal Reserve electronic data system that the gross domestic product for the United States printed negative for July. Look at this now. It didn't print much negative, maybe 1 or 1.2%, I think it is, but it was negative. So it's not positive. The economy is dropping. Look at this, is dropping like a rock, just falling off the cliff, and yet the Federal Reserve is being aggressive with its interest rates. This is going to cause turmoil virtually everywhere. Of course, make for a really strong dollar as well. Now, this is my industry. I told you we talked a little bit about real estate. Now, in my timing models, I've been thinking we weren't very far along, because we hadn't gone to phase 3. So now in phase 4, this would correspond to like 2008, 2009, 10, right in there where we went into recession. We had oversupply, overexuberance. You know, our builder friends, if they can build one and make a lot of money, well, gosh, they can build 10 and make a super amount of money. And they build way too much. They go into recession. Then we go into phase one. We go into recovery, where we've gone through. We start to get the absorption on the oversupply. And I thought we were in phase two, where builders have been very, very cautious about overbuilding. You know, they're being very, very diligent in limiting the amount of properties being sold per subdivision, and we have huge demand here. If you come here to Phoenix, Arizona, you are going to be just amazed at the construction and the new warehouses and plants and businesses that are opening up here, bringing in lots and lots of people. And yet the builders have been very, very constrained as to what they're bringing to market because they're having some supply problems. So I thought we were in phase two. This is where I thought we were at. But now let me just go here to phase three. This would be phase three, where there's lots and lots of increased vacancy, an awful lot of supply comes to market, and they overbuild. You have more product. But we're not there. But let me just talk about this scenario. These homes were built a year and a half ago. People are getting them. They qualified a year and a half ago when interest rates were 2.5% and 3%. Now they're 5.5%, and they can't qualify. It was just in the news that Pulte Homes, that their cancellation rate doubled. Now here you are, you're building homes. You're building homes for your buyer. You built this house. You didn't spec it. You built it for somebody. You're getting ready to close, and that buyer can no longer qualify. Now you have a spec. And what if that spec becomes more than one? What if it becomes two? What if it becomes 100? What if it becomes 1,000 specs because your buyer can't qualify because the Federal Reserve has raised interest rates and their business or their job is now at risk and they can't afford the payment? Well, it's a pretty tough scenario. And that would put us right here into phase three without us really doing that on purpose. It just happens. It's really funny how these cycles work. It's just absolutely incredible. Let me go to my next slide. Now I'm going to tell you, we've talked about this before if you follow my videos. Home buyer sentiment from the University of Michigan is at a historical negative figure. There is no home buyer going to be building a new home anytime soon. And look what's going on here. Here's the home builder sentiment from the National Association of Home Builders, and it's falling too. They are getting scared. You know, they don't want to build 1,000 specs. That's not what they're in a business to do. And these builders are getting concerned because the traffic is coming down. Now, this is going to be probably pretty good for us as investors. And maybe there's a silver lining to this that we can talk about, because, you know, as home mortgages go up, that means that we're going to pull the prices of rentals up too. So you're going to start seeing a lot of probably going to still see some higher rentals, which is really, really hard, but the demand is going to be really strong. And look at the tenants. Here's a tenant that just got dequalified because his payment went too high, but he's got good credit, he's got down payment, you know, he's building a home, now he can't buy the home, he's going to become a tenant. Well, that's great for us as investors, very, very bad for the family, because it's so much better off buying your own home. Let me go to my next slide, let's just talk about that. Now, there's all kinds of turmoil coming. Now, Charles has been forecasting us. Now, we just did a public video no more than like 2 weeks ago. As I said, you're welcome to go take a look at that. And we mentioned the fact that we're going to be doing a private live webinar. So Charles is going to be available. So we're going to be able to take questions from the people that are attending and ask Charles to answer it. We're going to try and shape the webinar to the inquiries from the people who are joining. So if you have interest in gold or Bitcoin or stocks or bonds or whatever it is, whatever field it is, we're going to try and put that presentation together and try and address that as best we can. Obviously, we can't get absolutely everyone because there might be a divergence of people with questions, but we're going to do our very best. So it's going to be really, really interesting. There'll be a couple different tickets, one that you can just listen to and of course submit your questions, but there'll be no guarantee that we're going to be able to get to that just because of the obvious problems. I'm going to try and keep it about an hour, but it's going to be really interesting. So here's a question that you're going to be able to get. So you have an hour with Charles Nenner. It's going to be very, very reasonable. It's going to be kind of like a beta test. So here's the numbers. You can always reach at info@charlesnenner.com, and you can always get me. So I'm going to be there as well. This is going to be August 7th. It's going to be a week from this coming Sunday, so it's going to be about 5 o'clock Eastern Standard Time. You're welcome to join us. You're welcome to find out, get all the information from the Nenner organization. You can reach me at michael@michaeldouville.com. My very, very best to you guys. If we can help in any way, please give us a call. Please email us. It's going to be challenging out there for the next few quarters. My best to you. Bye-bye.